Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about SoFi. So, I've kind of called this stock a stock stop clock. I'm going to go through what that means. I'm going to go through how this pertains particularly to SoFi. Going to talk about the overall sentiment here, why it's quite negative, and how to think about this. Then we're going to talk through and pick what the opportunity is. So, just stay with me, right? So, if you kind of been investing in high growth names, I mean, this is really like a setup that you've seen since the back end of, like, say, September, October. Things have just been selling off, and December, it just things got obliterated, right? And it doesn't matter if it's Sophie or it doesn't matter if it's like just this space in general, this high growth tech names have really kind of been particularly hit in the small cap area, small mid cap kind of area. And so I'm going to go through and kind of highlight, right? So, um, you know, allow me to just kind of offer you some perspective. So, right now, if you're invested in Sophie, you're probably holding a loss, right? And everyone says, oh, stocks go down as well as up. And when you made an investment in Sophie, you've already endured the pain of being investing in the kind of the stocks goes up as well as down perspective. So it doesn't necessarily mean that the majority of the sell-off, it doesn't necessarily mean that the sell-off is completely done, but the majority of it has finished, right? So the amount and the pace of the sell-off is done, right? So from this point, the risk reward has become really, really favorable. And the reason why I called Sophie a Sophie a stock stop clock is because what happens is anytime that you've made an investment, you kind of commit in that investment to approximately 12 months, right? So, you don't kind of want to buy something and then sell it because every time that you sell, you're going to buy something else and you won't know that new investment as well as you know the investment you're in. If you hold Sophie, you kind of, at this point in the game, you are very much aware of everything that's wrong with it. You know it, I know it, and I know that's already factored into the share price. So why I call it a stock clock is because you're gonna sell this stock, you're gonna buy something else, and it winds the clock back up. Because every time you make an investment, you're gonna be holding on to it, let's say for 12, 18 months or something. So every time you kind of exit a position to go for something that's better on the other side, you're really winding the clock back up, like a stopwatch. You're kind of winding it back up. So here are some of the things that I wanted to highlight. Okay, so when you're kind of in this mind frame that you're going to be investing in a business, by thinking of it as a stock clock, you're kind of thinking about it and you're not going to be jumping in from one position to the other because the grass is always greener on the other side, right? So if you're kind of committing yourself to be investing in the business, let that business deliver you the value, right? That compound that everyone talks about, the compounding is you holding on. You're making the investment and you're giving it time. So it's not trying to time the market. Oh, the stock looks good, the stock looks bad. Just stay with the business so you don't wind the clock back up. And oftentimes, things appear to be dead money. Never sell because it's boring to wait and hold on, okay? And one more thing that I want to highlight is that investing shouldn't be fun, right? As long as you look dispassionately through Sophie and you find that the fundamentals are improving, stay with the company, okay? Now, one of the things I wanted to mention is that, when I look at Sophie, like you can see the growth rates are strong. That's not the argument here. Nobody's questioning the growth rates, okay? There's a few kind of questions about whether it can be a super app or not. Uh, that's a theme that's really, really hot right now in tech. You got Block is doing that. You got a firm trying to get in there. And everything boils down to whether you're able to cross sell. You kind of get the customer in, you have a certain amount of customer acquisition cost, and whether you can translate in that into a high loan lifetime value. And it's kind of that's a bit kind of speculative whether they can reflect that, but here's what I wanted to show you, right? So you can see here in the graph, members are rapidly increasing towards the platform, right? So anytime that you see a very large growth in customer or users, that's often more insightful than actually thinking about the share price. The share price kind of is there to kind of distract you and confuse you. But if you look at what customers are actually doing, that's really where you're going to get your revenue from, and that's where it's going to drive the intrinsic value of the business. Now, one of the things that I wanted to mention is that everyone is kind of thinking about, oh, over the last 12 months, the profitability of the business is really, really low. So you can see here the EBITDA is kind of really, really low. And if you're paying close to 11 billion and you're getting 37 million of EBITDA, it's kind of like, it's not really kind of worthwhile getting involved. And I get that, right? So that's one of the bearish considerations that people point out to it, that it's very easy to kind of have a loan origination, and it's kind of difficult to actually have that successfully monetized over the credit cycle. So that's one of the things that people kind of mention. Now, here's the thing, right? So they're in the process of getting the approval for a bank charter. If they get the approval, which we don't know if they do, but if they will, this year they're going to make close to 450 million of EBITDA. Now, for a stock that's priced at approximately 11 billion, that kind of about 25x EBITDA you're paying. So if you compare, let's say, with, let's say, Robinhood, which I've also kind of talked about in the past, I've actually put an article called Prospects Dire, and the stock is down about 25% in the last several months since I put that out. Also compared to a firm, those stocks are really, really expensive, and you're paying kind of closer to 15 times sales than you are close to 25 times EBITDA. So there's a large discrepancy there, and the reason why Robinhood and Affirm are so richly valued because people really, really resonate. It's a consumer-facing brand, and people really, really resonate because those have a large following, and people just kind of clamor towards those businesses. Meanwhile, SoFi is trading really, really cheaply, and if they get the charge approval, you're going to see that stock trading close to 25 times EBITDA, which I think is really, really attractive. Now, a lot of people say to me, Michael, oh, you kind of invest in Upstart, and isn't Upstart and Sophie the same? No, they're not the same, right? So here's the thing, right? Here's the balance sheet and of Sophie. So Sophie has a lot of credit risk. So they have to, that should be factored into the share price. And I believe that is already factored into the share price, but I wanted to highlight. So you can see here in the graph, I put 2 arrows, so you can see here that its balance sheet is leveraged. It's not, a very strong balance sheet. And I'll compare. So you can see here, you got 2.7 billion of debt for Sophie, and this is the balance sheet for Upstart. And you can see here, the only thing that they've got is that convertible loan at 0.25, and it ends in 2026. So the balance sheets are like, night and day. I think that there's a very big difference, and I don't think that it's fair to say that Upstart is a bit like Sophie. They're very, very different business models, totally different, And Upstart's ability to just be taking a bit, it's kind of like a middleman, right? Its ability to kind of offer people a rapid approval to loans is very, very different from what Sophie's trying to do as being a super app. I mean, it's like so many people kind of get confused that I've got other videos on Upstart, and you can kind of check that out. But I just think that when if you look at like it's just night and day, these two balance sheets. Anyway, but the thing I wanted to highlight is that if you're investing in Sophie right now, I mean you're already holding a loss, and I think that the business has a lot of potential, and it may not be the best fintech to invest in right now, but at this price point, the odds are really favorable, and I hope that it works out for you. So anyway, if you're not going to find out what names I'm investing in right now, don't forget to check out my marketplace. It's called Deep Value Returns. And yeah, you can see what other people said. Check out my reviews. And yeah, thank you so much for listening. Bye bye.